Don't forget to subscribe to the Retire Young podcast on Apple Podcast, iHeartRadio, and Spotify. If you're just tuning in, Al was shedding some light on how these financial markets or the stock market really works. It comes down to supply and demand, which is where the big boys, the big institutions, the smart money is buying, but also where they're selling. So us as an individual investors, we kind of want to jump on their coattails and trade like a bank and not against them. And Al, as we get into this next segment, we have a lot of listeners that want to understand how that smart money is creating income with the stock market, because we all know the stock market, and there's some phenomenal opportunities that are happening right now. We got some great volatility, which means these stocks are moving pretty fast, which is kind of what you want because it's technically a slow-moving market. Now, how can us as individual investors utilize the stock market like the institutions do for income?
Well, I think one mistake people make is that they think and act like retail traders, not thinking and acting like the pros. And if you look at how the pros, how the smart money invest compared to the retail traders, it's really totally different. And when we talk about these big moves up and down, the volatility that we're seeing right now, the pros, the smart money is taking advantage of those moves, whereas the retail traders pretty much are sitting back saying, well, I'm just going to hold on and not do anything because that's what I'm told to do.
Who's telling them?
The pros are telling them. The smart money is telling them to do that, and that's a great business model for them because it's the way they make the most amount of money with the least amount of work.
Yeah, well, think about that. If the pros are telling the public to do a certain thing, that's kind of like, what's a good example? Let's bring a sports analogy here. That's kind of like one team, we'll say the Los Angeles Lakers, telling the Portland Trailblazers, here's what you need, here's what plays you need to run every single when you're playing us, right? Because they're kind of fighting against each other.
Yeah, what
Same
happens
thing
to
in the
your
financial markets,
right? What happens to your chances in a situation like that?
Yeah,
and
they know the hand. It's like knowing the dealer's hand,
right? So here's the thing. Everybody would love to make the perfect trade or the perfect investment. Is there such a thing? Yeah, probably not. In fact, absolutely not. But what you want to try to aspire to something as close as that as possible. And you mentioned that in the first segment, and that would be something where you have a low risk entry point or exit point with a high probability of succeeding with a high profit potential. Those are three components of what everybody should try to achieve. And I think the way to do that is there's twofold. There's two key elements to any trade or investment. One is timing. That's timing your entry, timing your exit at the best price, where a trend starts, where the trend ends, and then also choosing the right asset to trade. And for many people, it's stock. It may be equities. For some people, it may be the other assets we talk about, futures, forex, or options.
Yeah, well, the stock market is such a great place for individuals to start because it's there, it's available, and we all know that as well.
Right, and it's a great way for people to participate in the businesses that are out there. In whether you're trading for short-term cash or income or long-term, looking at building up your wealth or your retirement, there are ways of using these assets that will give you the better benefit. There are strategies that you can use to participate in an up market. There are strategies to use in a down market or a sideways market. Unfortunately, Wall Street is putting most of their clients or advising them to be in something that only is going to make money in one direction. That's when the market goes up. And it does go up most of the time, but it doesn't go up all the time. It does go down. It does go sideways. And if you are in those markets and not participating to your benefit, then it's really wasted time. And for a lot of us, the older we get, well, for everybody, the older we get, the less time we have to kind of come back from sitting through a correction or a bear market. The smart money out there not only participates in a bull market, but then they protect the bull market profits and they participate in a profitable way in the down market.
What do you mean by that down market, though? What is that called?
It could be a correction. It could be a bear market. A correction is when the market is down 10% or more. A bear market might be when it's down 20% or more.
But how can someone participate in a down market?
Well, that's a great question, and it's a question a lot of our students ask when they come in because they have never been counseled or educated on that. And there are a number of ways of doing it. One is to short an asset or the market, Which,
so like Apple stock, you could short Apple if you wanted to, or you could short Netflix or whatever that may be. That's possible, right?
correct. Or you can short the NASDAQ or the Dow or the S&P 500.
Okay.
Shorting is a concept that hasn't been taught or is not understood very well by a lot of people. It is probably the primary way that the smart money is participating in a down market. Basically, what you're doing is borrowing something, selling it with the promise of returning it. In other words, buying it back later and returning it. So the goal there is to sell something at a high price, buy it back at a low price, return it, and then your profit is the difference between what it was sold for and what you purchased it back for, what you kind of closed out that short position for.
Yeah, it's just the opposite of buy low, sell high. And
Exactly.
Everybody knows buy low, sell high, but most people don't really know how to do that properly. You mentioned timing. You have to have the right entry point, where to get in at a low price, and then that exit point, where to get out at that higher price. But you also want to have the right asset. We're going to get into the right assets coming up here next. But Al, you talk a lot about the stock market and how the stock market really works, but how us as individuals can utilize the stock market kind of like the institutions do. So, Al, you mentioned you need a couple different things. You need the right timing. You got to have the right probabilities or the odds in your favor.
Sure.
But you also want to have the right asset. We all know stocks. We kind of dissected stocks here for the first 1.5 segments here. What are the other assets you can use included to the stock market?
Sure. And people have the opportunity, if they want to participate with a number of different things. It doesn't have to be just one. You don't have to choose one, and that is it. But most people know the stock market because that's what Wall Street has maybe mentioned or taught people about. Mutual funds are combinations of stocks, and that's probably what most people are invested in their retirement accounts. But why is there a difference? Why is there such a difference between what the smart money does as far as their returns and what the public does? And it's a significant difference. And the reason is that the smart money not only knows the right assets to choose, but they know how to make sure that they are protected. Risk management is a big part of what provides their success. But the proper assets, there are assets in addition to stock. There is the futures market. There is the foreign exchange market, the options market. Those are all assets that they're used by the smart money out there. They use them either in a long position, in other words, when they feel something is going to go up in value. They use them in a short position when they feel something is going to go down in value. I mentioned shorting is something where you borrow something you don't own and sell it, and then with the obligation of buying it back. But you don't have to short to make money or to participate in a downward moving market. You can use options. Options, there's two options. There's a call option and a put option. One of those two will go up in value when the underlying goes down. With the futures, you're looking at the major stock markets, commodities, oil, sugar, corn, soybeans, gold, silver, currencies, interest rates, a number of different things. A lot of opportunities, probably the best diversification asset that there is. And you don't have to just go long. You can sell those contracts. In other words, you're not borrowing something. You're just selling a contract. And the same thing in the foreign exchange market, where you're looking at the difference in exchange rates between two different currencies. You can go long, you can go short. So you can participate in different directions there. Options can be used in a sideways moving market, and an up market, and a down market. There are a number of choices that are available that unfortunately most people are just not counseled on or educated on. But that's what the smart money is using. They use those on a regular basis, but they put most of their clients or suggest to them that they just do what we call a buy and hold strategy, where they put together a portfolio and then hold on to it for decades. And if that was the best way to participate in the financial markets, why aren't they doing that with their own money? Because they're not. Well, maybe it's because they're seeing financial benefits on a regular basis, not just a decade-long basis. And if you want to know what they're doing, why they're doing, how they're doing it, those are the things that we talk about in these classes. We go into more detail on them. And if you want to participate with the smart money the way they do it, these are things that you should learn, that you should have some understanding on.
Yeah, the funny thing is you were saying most people aren't counseled on this. Most people have never heard of it. They don't know what they are. But what's great about the Retire Young radio show is a lot of people are listening all over the country right now, but even all over the world on the podcast. So people that are listening to the show are being, have an understanding, because we talk about this every single week about how these other markets really work. And we've been kind of noticing that in these investing classes that, when people are coming in, they've been having a little more knowledge just by hearing the show, but also they're coming to hear more about and learn, just get more knowledge on that. So you were talking about different opportunities in the market. Explain what an ETF is, because there's opportunities in up and down markets with those ETFs.
Yeah, an ETF is not an alien that lands in your backyard.
It's not ET phone home.
No, it's an exchange traded fund, which is a basket of stocks. It represents something. It could be an ETF or an exchange traded fund that represents the S&P 500 or the Dow or the NASDAQ or the Russell. Could be an ETF that represents technology stocks or financial stocks or healthcare stocks. There's probably 7,000 or more ETFs that are available, and everybody has access to those. They are there are ETFs that act in the opposite direction of what they're mimicking. For example, with the S&P 500, there is an ETF that mimics the ETF, or that mimics the S&P 500 close to dollar for dollar or point for point when it goes up, but there are inverse ones that do the opposite. So if the S&P 500 is down 10%, an inverse could be up maybe 10%.
So that's a lot more comfortable for people that they want to be able to buy something and technically participate as the actual market is going down.
Correct.
Because those are going up. So it's still, you're still buying, but the market is actually going down. It's more comfortable.
That's exactly right. In exchange-traded funds like that, those inverse ETFs can be used in a retirement account, in an IRA. You can't short in an IRA, but you basically get the same benefit by doing an inverse ETF. You're participating in the downward moving market, whether it's the market in general or individual sectors or industries. You can also participate in a downward move with options, and that's something that the smart money is using. Those guys like Warren Buffett. Warren Buffett uses options, but he doesn't talk to the public about that.
Yeah, the great thing about options too is you're utilizing the stock market, just buying contracts rather than shares. So it's the same market. You're just doing something a little bit different. And you talk a lot about those different markets in these asset classes. But a couple key things that I just want to make sure our listeners understand. We talk a lot about those C words, and choices is that big one. You mentioned that you have more choices when you understand multiple asset classes, and really all that does is bring us as investors or the average person more opportunity. And it all comes down to taking advantage of opportunity. Al, coming up in this next segment, we have a lot of listeners that want to get ready for retirement, and they want to have a more comfortable life, but also have more confidence with getting to that point in their life. So I want to get into retirement accounts and retirement strategies that us as individuals have, the same opportunities that we'll say the smart money has as well. This is Josh and Al with the Retire Young radio show. We will be right back.